All right, everybody, we're straight into the computer today. No need to go to a close-up to me because we got to get close into these tweets that Cathie has just spewed out. And it's really important we analyze them because she's saying a lot about inflation and really hinting that 2022 may be a really strong year for growth stocks. We're going to analyze it. We're going to talk about it. We're going to understand her logic. And we're going to deep dive into what she's actually trying to get out here on this 9:21 p.m., December 29th, a couple days before the new year, late night Twitter rant. Okay, first tweet. Today, we learned that in November, retail inventories rose more than 2%, the fastest pace since the 90s, while imports jumped 4.7% and exports dropped 2%. Moreover, real consumption, including services, was flat and the savings rate dropped to 6.9%. Now, what is she saying in this first tweet? The first argument that Cathie is trying to make is that we are exporting less than we are importing in America. And this makes a lot of sense because in America, we've had a lot of supply chain issues. And so we want to make sure our supply chains are better, which means we want to get a lot more goods on the shelves. So we want to get a lot more products in our stores. However, the caveat here is that consumption, and she's saying real consumption, including services, trying to account for all forms of consumption that are happening, are flat. And the key here, the impact to this argument that she's making is that if we have a lot more goods that we're bringing into the United States, but people are consuming a lot more of those goods, meaning people aren't buying as much of that stuff, that means we're leading towards a deflationary effect. The reason this is deflationary is because the way you deflate an economy is you stop pumping a lot of money into it. And if consumers that for the past 12 months have been pumping a lot of money into the economy, not only because they got stimulus checks, not only because they got unemployment, but also because they had so much savings because during the first 4 or 5 months of COVID, people weren't spending that much money, that by, October 2020, everything just started going crazy with the money that was getting into the economy. That's probably some of the reasons we've seen the stock market have such a bull rally since then. So if consumption is going down, but products and services are still increasing in terms of their inventory, that is naturally going to lead to prices decreasing because there's less demand for the supply that exists. When there's more demand and less supply, prices naturally go up. When there's less demand, a lot more supply, prices are going to start to go down. So this is the first part of the argument that she's setting up. Next part, as measured by the University of Michigan, which I believe is the best monthly survey, so this is one of the surveys she trusts as an analyst, sentiment during November and December dropped to a level last seen at the worst of the coronavirus crisis in 2020. In this context, the percent changes listed above make sense. So what does this mean? When consumer sentiment is dropping low, particularly over the past couple months, November and December, that means that consumers have less of an affinity to spend money in the economy and in the markets in general. Now, what are the reasons for some of the consumer sentiments dropping low? Well, we had a lot of things happen in November, December. First of all, we had the Fed say that they're going to start tapering and potentially raise interest rates. And now it's like almost guaranteed that they're going to raise interest rates. When you raise interest rates and you start to taper, that means you are trying to do things to deflate the dollar, and you are trying to do things to not stimulate the economy. You are trying to pump less money into the economy. You are trying to make it harder for people to pay for borrowing money. So the cost of borrowing money becomes more expensive because interest rates, the rate you have to pay to borrow that money, becomes higher, which means in general, the economy tends to slow down, and you're trying to get it to slow down because it's going way too fast. This is the job of the Fed, which is an apolitical institution, and it is a very difficult thing to do. The White House isn't doing it. These companies aren't doing it. The Fed is the institution that is responsible to enact these types of policies in order for this to happen. So if consumer sentiment is going down in November and December, then that's naturally a good thing because less money is going to be pumped into the economy. So outside of the Fed, you also had the Omicron virus concerns. And the Omicron virus concerns led to more people feeling that, oh, maybe they should protect their money. They should be a little bit more conservative. They shouldn't put that much money out there because of the fact that there could be another potential pandemic. Obviously, it doesn't seem like Omicron is going to be that insane. But nonetheless, this led to the decline in consumer sentiment. Overall, if consumer sentiment declines, that is a good thing for her argument, because if she's correct on this and if these numbers are actually true, that means there's less spending in the economy, and we need to reduce the amount of money that's being pumped in the economy if we do want to have deflationary effects versus inflationary effects. She next says these percent changes are not annualized, so multiply them by 12 because 12 months in a year. Both businesses and consumers seem to have been overreacted to supply chain bottlenecks by building inventories of goods while government stimulus was flowing freely. Now, this goes back to the video I did, and I'll link it in the description, when I summarized the 24-minute article that she released. What was this? Around Christmas, around like December 15th, December 18th, where she basically said that consumers are building up so much supply in their home because they're afraid of things that may happen. This is why during Black Friday, some of the Black Friday sales were absolutely exponential and amazing for companies, because consumers felt that they wouldn't be able to get Christmas gifts for their family because they felt that because of the supply chain problems that exist, there wouldn't be enough semiconductors and chips in order for them to buy their new laptop. And I saw it. Even I went to Best Buy with my cousin on Black Friday, and we went to get a laptop, and thankfully we were able to get it. But there were a lot of people buying a lot of stuff, and it's primarily because people were concerned that if the economy is slowing down and there's supply chain problems, that we need to get more goods, which means we have to spend more money. And if we're spending more money, that's only going to be inflating the dollar at a time where it's already having inflationary effects. Now, obviously, to Cathie's point, this is dramatic, and this was not required because we didn't have the supply chain problems at the level at which people thought we had the supply chain problems. And that's being shown now with inventories coming in and consumption of those inventories being flat. So the logic in her first tweet is justifying the fact that she thought it was dramatic during Black Friday, Christmas time for people to load up on inventories because there wasn't that big of a supply chain bottleneck problem that the rest of the market thought that there was, or the rest of consumers thought that there was, which is why they ultimately bought all those different goods and services. Now, she next says, these developments are not new. During the third quarter, real GDP was up a little more than 2% at an annual rate, but real final sales, consumption, investment, excluding inventories, government spending, net exports were flat. That 2% growth was all in inventories. Again, she's saying there's a lot more growth in actually stocking up supply and flat demand, not increasing demand for all that supply, which is the sort of real GDP or the real percentage change argument that she's making with this 2% number. That means that consumers overreacted and there's not that much consumption that is happening or will happen going into 2022, which will lead to deflationary effects. Her next arguments. Now, this stuff gets pretty interesting. This buildup, along with M&A and IPOs, reminds me of Y2K. The time the excesses are likely to be in industries and technologies that will disrupt energy, financial services, transportation, among others. If so, this disruption will be the flip side of Y2K. So what was Y2K? Well, now, I was 3 years old during Y2K. That was when we turned from 1999 to 2000. And everyone thought that the computers would go crazy because they thought like there was a glitch in the calendar and the computers wouldn't know how to go from like December 31st, 1999 to January 1st, 2000. And like the world would end, right? Because these computers would just like all collapse and stuff. It was kind of stupid. But the point is, there was a lot of tech run up. This was sort of the dot-com bubble back in the 1999, 2000, 2001. And there was so much money chasing these tech companies because we thought there was going to be so much innovation. The problem is that bubble collapsed because that innovation ultimately didn't happen because the technology wasn't ready at the time for that innovation and for that growth stage to actually occur because there just wasn't good tech at the time. But investors thought there was a lot of good tech. This time, her argument is there is a lot of good tech. And because there is a lot of good tech, energy, financial services, transportation is probably Tesla, financial services, she's talking about blockchain, energy, she's talking about energy storage and renewable power. All of these technologies that ARK is heavily invested in are the actual companies that are going to disrupt everything. And the only way that disruption happens is if a lot of money starts pouring into these companies. Well, how do you get a lot of money pouring into these companies? You get a lot of money pouring into these companies through her next tweet. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies, many of their equities maligned this year, should be rewarded handsomely. When there are fears of inflation that are starting to go down, or and the world becoming more deflationary, and so at the same time, inflation turning into deflation, and a fear of a recession happening. A fear of recession meaning the market and consumers in general feel that the market is about to collapse, especially because the S&P is at all-time high. People kind of feel like we're at a bubble, and people feel like the market is unsustainable at this time. All of the money that is in the market is going to go to growth stocks. The reason it's going to go to growth stocks is for two reasons. When inflation is high, that's when money goes into value stocks, companies where we feel that they don't need to borrow money, i.e. they don't need to pay high levels of interest rate. They don't have a lot of debt. They're making a profit. They actually have products and services that consumers are paying for. So your money is safe during times of inflation because you know that the money, because interest rates are going to go up, you can't put your money into high growth tech companies because those high growth tech companies are going to have to pay a lot of money to borrow a lot of money. And in general, high growth tech is not something you want to be invested in when inflation fears are high because they're risky investments. So that money immediately goes out of those sectors. That's exactly what we've seen in November, December. That's exactly why ARK is down 40% from its all-time highs and other tech companies as well. But when it's becoming deflationary, that money starts to trickle back into tech because you want to get growth as much as possible. And when there's a fear of a recession, you don't want to put your money into things like consumer goods, right? Or like regular products and services because people won't have the money to be able to buy those things. Why would you put your money into Home Depot when there's a recession? When you know people are not going to go buy a lawnmower, right? No one's buying a lawnmower when there's a recession because that $600, you're saving that money. So investors are not going to put their money into companies where they feel that if they feel a recession is going to happen, they're not going to put their money into companies that are stable, good picks. They're going to put their money into companies that are innovating and companies that can get growth at all costs. These are companies like Teladoc, Palantir, Roku, et cetera, Shopify, some of the main ARK holdings that are growing exponentially. And because they're growing exponentially, they are recession proof, right? Because recession depends on companies or consumers not buying things from traditional stores and traditional institutions. But high growth tech companies don't need to rely on consumers buying a lawnmower. They rely on AI, innovation, machine learning, et cetera. That money trickling into those high growth tech companies, especially with the fear of a recession and deflationary effects, is going to lead to what she says, handsome rewards for the truly innovative companies. And truly is also a very important word here because truly means companies that are actually innovating, not companies in the Y2K era that just put a .com behind their name and said that they were going to be the next major internet companies. And that's sort of the argument that she's going for here. So the reason she's saying this is because she believes that consumer sentiment is going down to buy goods. Inventories are loading up. That's going to lead to deflationary effects. Those deflationary effects are then going to lead to some level of a fear of a recession in the next 3 to 6 months. And that's ultimately going to lead to handsome rewards for innovative companies. Now, is she right about this? I don't know. I am very excited as someone who is really, beginning to understand the stock market and understand investing a little bit more to see if she is right about this. I'm going to be very honest. I don't know. I think in the next 3 to 6 months, her argument makes a lot of sense. We will have to see consumer reports over the next couple of months, along with CPI data for inflation reports to see is inflation increasing at the levels that it's been increasing over the past couple of months, and is consumer sentiment being flat or going down, as Cathie Wood is saying. If those two things hold up to be correct and they're trending in the way that she needs them to trend in order for her argument to be correct, then there will likely be a rotation into more high growth tech stocks. The question becomes, is she correct about that? And is that actually going to happen? I don't know if she's right about this. I'm excited to see if she's going to be right about this. My hair is kind of crazy. My hair is acting as crazy as some of these high growth tech companies have been acting over the past couple months, but maybe it gets a little bit more crazier based upon what happens with inflation and consumer sentiment, and if people actually start spending money or not spending as much money in the economy, and if we see these deflationary effects. Let me know what you guys think. This was my analysis of Cathie Wood's tweets. Really good tweets, really good understanding of where her head is at the market right now. Her strategy has not changed. She believes we're going to have deflationary effects, and she also believes that money at the fear of recession is going to put more money into high growth tech companies, and when that happens, if you're invested in ARK or any of the major ARK companies, you may be rewarded. Let me know your guys' thoughts. Thank you guys for watching. My name is Mitt. Looking forward to reading the comments. I'll see you in the next one.